Today's module is focused on the basics of investing to ensure the beginner investor has the information that they need. And this presentation has been broken down into 3 comprehensive sections. Now, in the first section, why invest, we will discuss the importance of inflation, the differences between saving and investing, and an introduction to compound interest. And next, we'll talk about the different types of investments and how each one grows over time. And finally, we will talk about how important it is to invest efficiently. That means being aware of the various investment accounts and how taxes can impact your investments. Now, before we get started, I want to remind you that while investing can be complex, the basics are really all that you need to get started, and that's what we are covering today. So coming out of this workshop, we really hope that you will have learned the foundational skills to allow you to invest with confidence and why it's important to invest for your future to help outpace inflation. 2, what basic investment asset classes exist, and 3, the various account options there are to investing. So let's get going on investing basics. So to start off, it's worth mentioning that in the world of investing, there's lots of jargon or special terms, but that's really common for any subject. So of course, the business world is no stranger to lingo like bang for your buck and due diligence. And millennials even have their own jargon like TTYL or TBH or FOMO, and a few others that probably wouldn't be appropriate to mention on this presentation. And I mention these terms because perhaps you're more familiar with them more than you are with investing language. But either way, it speaks to the fact that every subject area has its own terminology. So today we're going to go over several terms and teach you their meaning so you can start picking up on the language and speaking the language of investing. So we should have a poll coming up. There we go. So if you see the terms on the screen here, and I just want to know if you are familiar with all of these terms, or most of them, or some of the terms, or none of them at all. Okay, so we're seeing we got some of these terms, all of these terms. Looks like we're sort of balanced between most of them and some of them. Right, good. So why invest? Well, the role of investing is to put the money that you don't need today to work for you to help you achieve your goals in the future. So in other words, investing is about making your money work for you. Now, in this section, we'll discuss the importance of inflation and how it affects your money. We'll also discuss the difference between saving and investing. And finally, we'll look at how compound interest helps your investments grow exponentially over time. And these are some very important fundamental topics for investing, so let's get to it. So inflation causes prices to rise over time, which means that your money today will be worth less than it will be in the future. So while some level of inflation is good and shows that an economy is growing, it is important to keep the concept in mind when investing. So how does inflation affect you? Well, over time, the purchasing power of your money will decline, meaning that you'll be able to buy less with the same amount of money. So for example, a loaf of bread cost about 25 cents in 1970, and today it costs more like $2.50. So if you put your 25 cents for bread money under your mattress in 1970, and then tried to buy a loaf of bread with it today, the store manager would probably just laugh at you. You must invest that quarter to ensure that you have at least $2.50, 50 plus years down the road, or you won't be able to afford the same standard of living. So why does this matter? Well, if you are saving money without any interest, then you are technically losing money because inflation is reducing its value over time. Canada's annual inflation rate generally ranges between 1 to 3%. So if you want your savings to keep up with inflation, then you would need to earn at least 1 to 3% annual interest on your savings. And in the past 10 years, Canada's inflation rate has ranged from about 0.6 to 3%, although in the late 70s and early 80s, Canada's inflation got into the 12 to 14% range. So we're going to look at saving versus investing. And first, when it comes to saving and investing, there is no chicken and egg dilemma. You don't have to wonder which one comes first. The truth is that you cannot invest if you don't have savings. Now, once you have savings, you can make decisions about how to invest them. Saving is holding on to some of your money to use in the future, while investing is what you do with those savings. So therefore, investing is not only for those with lots of money, which is a really common misconception. Anyone who has savings can make decisions about how to invest those savings and put them to work. Now, a regular savings account is one of the safest places to put your savings. And Canada's banks are very sound, and you don't have to take on a lot of risk by putting your money into a regular savings account. And while a savings account is very low risk, it also gives you a very low return. And that is one of the most important lessons to learn early on about investing, is that low risk will often mean a low return. And shortly, we'll look at some alternatives to putting your money in a regular savings account. So let's compare with the following 3 examples to get a better understanding of the importance of investing. So conservative Carl decides to hold his money in cash, and over the long run, he will lose money because inflation will reduce the $30,000 purchasing power, meaning he will be able to buy less with the same $30,000 in the future compared to today. Now, Safe Sam decides to put their money into a savings account offering a 1.5 interest rate. Over the long run, the interest gained in the savings account will make up for the inflation. Therefore, in the long run, the value of their money will remain the same. Now, Incredible Ingrid decides to put her money in an investment, earning a 5% interest rate. Over the long run, she will grow her original investment with even the inflation included. This is because the inflation rate tends to be around 1 to 3% per year, whereas the investor is earning a 5% interest each year. So the term real return refers to the return one earns after adjusting for inflation. So in this example, between the 3 of these people, only Ingrid is earning a real return, since the 5% annual interest rate she earns beats out the 1 to 3% inflation rate. So you may hear someone talk about the magic of compounding. Now, this refers to how savings and investments can grow in value more quickly because of something called compound interest. So we're going to take a few moments to watch this video, which further discusses the difference between simple interest and compound interest and illustrates the impact of compounding over time.
Let's assume a very generous bank offers to pay John and Lisa a return of 10% per year, and they each invest $1,000 called a principal. John wants to spend the interest each year and only keep the principal in the bank, while Lisa wants to save for 30 years. So she doesn't take the interest out each year. In John's case, the 10% amount to $100 each year. So after 1 year, he'll have $1,100 in his account, out of which he'll take $100. After the second year, he'll once again have $1,100 in his account, out of which he'll take $100. After the 30th year, he'll have $1,100 as usual and take $100. He will be left with $1,000 in his account. So his principal and the returns he made amount to $100 multiplied by 30, so another $3,000. A grand total of $4,000 that he made over 30 years. Lisa, on the other hand, will make more. After 1 year, she will have $1,100 in her account, but she keeps everything there. After the second year, she will earn 10% of those $1,100, and not only on the initial $1,000. Therefore, she will have $1,100 plus $110, so $1,210. After the third year, she will earn 10% of those $1,210 and have $1,331. After year 30, she will have $17,449.40, over 4 times more than John.
Awesome. So I would like to first note that 10% interest in a bank account is not realistic, but the general premise remains the same. So quickly to review, the magic of compounding refers to how savings and investments can grow in value more quickly because of compound interest. And that's the magic of compounding, and that's the magic of saving and investing. So if you start investing at a young age, you have many years for your money to grow through compound interest. And if you can add more to it each year, your savings will grow that much faster. So using the magic of compounding to help your investments grow whenever you can. So looking at this chart here, we can really see the significance of compound interest. So the 2 lines that you see represent 2 investors who invest the same amount of money over time. So the blue line investor earns simple interest, whereas the red line investor earns compound interest. Now, if you look at the blue line, simple interest, you'll see that the growth is pretty linear. And this is because the same amount of interest is being earned each year, and the interest earned each year is being removed from the account and not being allowed to grow. Although if you look at the red compound interest line, you'll quickly notice that the growth is exponential. So here we see just how powerful interest on top of interest can be. Now, even though the red and the blue lines start at the same place, over time, the red line's earnings begin to heavily outweigh the blue line's earnings. This is because the red line is earning interest on top of the interest they made from previous years, and as time goes on, this becomes more pronounced. So try to think about a $10,000 investment earning 10% interest compounded each year, which again, 10% return. We only use that to make the math a little easier. It's a very high return and highly unrealistic in today's environment. Although after the first year, the account grows from $10,000 to $11,000. And in the following year, the 10% interest is earned not only to the $10,000 initially, but also the $1,000 that you earned. So this process repeats itself for each additional year, and you end up earning interest on top of the interest you've already made, and over time, the effects of compound interest become more and more noticeable. So moving on to the next slide, we've seen now the, oh, there we go. We've seen the magical effect of compound interest, but remember, it takes time for compound interest to really pick up the pace. In this slide here, we'll be looking at just how important it is to start early. So even a few years early on can make a big difference on your investment portfolio size. So in this example here, the green line represents early bird Earl, who decided to start early and invest $100 a month from ages 21 to 41. And at 41 years old, they stopped contributing money to their account and let compound interest take over entirely. And by age 67, the account had grown to over $470,000. Now, the blue line here represents procrastinator Pat, who starts late and invests $100 per month from ages 47 to 67. Although by the time they turn 67, their original investment of $24,000 will have grown to a total of $59,295. So keeping in mind, both of these investors added the exact same amount of money to their account, which was $24,000. And the only difference is that Earl started early, allowing the compound interest to take a much larger effect on their account. So if you've ever wondered how long it will take until your investment doubles, you can use the rule of 72, which can be used to calculate roughly in how many years your investment money will double. So to calculate how long that would take, you can divide 72 by the interest rate being received. So say you were to earn 2% a year, it would take 36 years for your money to double, as 72 divided by 2 equals 36. And this can also be used to determine how much inflation will hurt your purchasing power. So if inflation is 2% a year, then the purchasing power of $1 will be cut in half in 36 years. And if inflation is more like 12% a year, like in the early 1980s, then the purchasing power of $1 will be cut in half in 6 years. And this is a really good rule of thumb to keep in mind relating to the concept of compound interest. So the next slide will have our key takeaways from section 1. So first, earnings more than inflation is important. Over time, the purchasing power of money decreases, which means the money that you have today will be worth less in the future. Therefore, in many instances, it's best to earn some sort of interest on the money you save in order to keep up with inflation. Second, you cannot invest if you don't have savings. So once you have savings, you can make decisions about how to invest them. And that means in order to start investing, you need to find small ways to set some money aside every month for the purpose of ultimately investing in you and your future goals. And finally, when should I start investing? The answer is right now. When it comes to investing, you want time on your side, which will allow for the magic of compounding to really grow your investments. So moving on to section 2, we will be covering the different types of investments and how they make you money. The goal of investing ultimately is to let your money work for you. And it's important to learn about the different types of investments so you can find out which ones are the most optimal for you. So we know about investing and you're considering investing, but what kind of investments are there? So compound interest is great, but there are other types of investments too. And in this slide, we'll look at some alternatives to a regular savings account. Though you can invest in all kinds of things like real estate and various collectibles, there are 3 general types of investments, and that's what we're going to be going over. The first category or asset class is cash or close to cash or cash equivalent investments. Those that are very liquid are low risk, but provide a relatively low return. So examples of cash or close to cash investments are those such as cash, bank deposits, term deposits, and guaranteed investment certificates, also known as GICs. And in each case, this form of asset rewards the investor with interest. And we've learned about simple interest and compound interest already. And you can buy a GIC at a bank that is guaranteed to pay a certain interest rate over a certain time. And it is very safe and usually pays more than a regular savings account. So another form of liquid investing is to open a high interest savings account, or HISA, and places like Equitable Bank, Canadian Tire Bank, and others will pay an interest rate that is much higher than a typical bank's checking or savings account. And also to know that up to $100,000 in deposits with any Canadian regulated financial institution or bank is covered by CDIC insurance. And a quick note on interest is that lower risk items will tend to have a lower interest rate, such as when you loan money to the bank in the form of a GIC, let's say, whereas a loan that is considered high risk will have a higher interest rate. And remember from on one of our previous slides that low risk often means low return. So the second common type of investment asset class is fixed income investments, also known as bonds. So bonds are basically a loan that you make to a government or a company. And unlike cash equivalents, you can buy and sell bonds in the bond market the same way that you can buy and sell stocks in the stock market through a broker. You can also get exposure to fixed income investments through balanced funds, which can be mutual funds and exchange traded funds, which we'll discuss a little more shortly, which often have a mix of equity and fixed income investments to help you balance your risk. And the market price of a bond will change in the bond market over time. And in this way, even though bonds provide fixed income or a fixed rate of return, they can be bought and sold in the bond market at different prices. Based on what happens to interest rates, a bond's market value may rise or may fall. And if interest rates drop, the bond's price will increase, although if interest rates increase, the bond price will fall. Interest rates are at very low levels, and so the prices of bonds will tend to be dropping in price in the next few years. And the longer the term of the bond, the more the price will drop if interest rates increase. In the end, though, whoever owns the bond when it matures or when the term is up will be paid back the principal by the company or government that issued the bond and borrowed the money. So you must then decide what to do with that money and reinvest. So your fixed income investments provide a fixed rate of return for a particular period of time if you hold on to the instrument until complete maturity. So another popular asset class is equities. That is buying a share of ownership in a company. So if the company does really well, the value of the shares or stock should rise, and the higher the stock price indicates that the value of the company is higher. Equity investments, like stocks, are riskier than fixed income investments. Their value is more volatile and less predictable. So a stock's value may rise or fall, sometimes by a great deal, and the possible return on an equity investment is higher, but so is the risk of loss. So equities provide investors value in one or possibly two ways. The first being capital gains, which is the rise in the value of the shares, meaning they become worth more than the price they were purchased at. Keeping in mind that the gain is not real until the shares are actually sold. So for example, you buy 100 shares of a stock for $10 and sell it for $15 per share, or $1,500, and you have a $500 realized capital gain because 1,500 minus the 1,000 is $500. And second, some equities pay dividends. Essentially, you get paid for owning a stock. Now, it's not the stock that pays you, it's the company whose stocks you've bought that's giving you a portion of the profits they make for you being a shareholder. And sometimes these payments are worth mere pennies per share, which may sound insignificant, although they can really add up over time. And as an example, we can look at an individual stock, which is, and this in no way is a recommendation for this stock, but rather just an example of how dividend yields work. So National Bank does pay its shareholders a dividend. Each company chooses how much of a dividend to pay. And as of May of this year, National Bank is currently paying 71 cents per share in quarterly dividends for a total of $2.84 per year. And based on the current price of $91.07, that works out to a dividend yield of about 3.13%. So National Bank has chosen to pay its dividends quarterly in 4 installments over the year. Other companies may choose to pay their dividends monthly, so 12 installments. And these dividends can provide a steady income stream, especially when you are in either retirement or between jobs during your career. And these dividends are in no way guaranteed, though they can go up or go down A good company will typically increase their dividend income paid per share over time. So moving forward, we can talk about additional investment options. So besides equities and fixed income and cash and equivalents, there are a few other popular investment types. So before we wrap up the second section, we can talk about two popular types of funds. So the first type, being a mutual fund, is when investors pool together their money, and then that cumulative sum is invested and actively managed by a professional. So fortunately, you don't have to go out and find a bunch of other investors to pool your funds with, because there are fund companies that will do this work for you. Additionally, investors can buy units of a fund that they want to invest in. So keep in mind, the value of units can change according to how well the investments in the fund actually perform. And if the unit value rises, the value of your investment in the fund rises. And if it falls, then the value of your investment falls. Now, there are many different kinds of funds offered by many different companies. A fund might invest only in equities, or only in Canadian equities, or only in US equities, while another fund may invest in bonds, or only government, or only corporate bonds. And another fund may invest in only precious metals like gold and silver. Really, the list goes on, and there are thousands of different kinds of funds. So in this case, you would also pay a fee to the professional and the professional's company for managing the fund. And the funds can have different kinds of fees. So make sure when you invest in a mutual fund, you know what fees that you're paying or may need to pay. Many mutual funds in Canada charge upwards of 2% per year multiplied by the assets you have invested into the mutual fund. So similar to mutual funds, we'll look at exchange-traded funds, also known as ETFs. So like mutual funds, ETFs are pools of investors' money that is then invested as a cumulative sum. And just like mutual funds, investors can buy units of an ETF, but because they are traded on the stock market, they are actually shares of the ETF. And again, the value of shares change according to how well the investments in the ETF perform. So if the share value rises, the value of your investment in the ETF rises, and if it falls, then the value of your investment falls as well. And you guessed it, there are many different kinds of ETFs offered by many different companies. Just like mutual funds, some ETFs might invest only in equities, or Canadian equities, or US equities, or only in corporate or government bonds or precious metals. Like mutual funds, there are just thousands of different kinds of ETFs. Now, here's where the differences actually emerge. So you will also pay a fee to the professional and the professional's company for managing the ETF, but it will be a lower fee than a mutual fund. And this is the most important difference. So unlike mutual funds, which are mostly actively managed, meaning a manager or a management team makes decisions about how to invest the fund's money in an attempt to achieve the fund's stated objectives, equity fund managers typically try to outperform the market. Most ETFs are passively managed, meaning that the fund is meant to mirror an established index or market, and as a result, ETFs are generally charging much lower fees as there's much less research required. So as an example, I could buy a Canadian equity mutual fund that I will pay about 2% in annual fees, or I can buy an ETF index fund like XIC, where I will only pay about 0.06% per year. So in other terms, the mutual fund manager must outperform the index by close to 2% to make it worthwhile to hold the mutual fund versus the ETF, if you are comfortable investing in the ETF yourself. So at the end of the day, we have to find our risk return balance point. And there are many, many reasons why one person's comfort with risk may be different than another's. But it will be important for you to have a sense of your attitude when it comes to investing. So some questions to ask yourself are, what level of risk are you comfortable with? What level of risk will let you sleep at night without worrying? And what level of risk do you need to take, or are you willing to take to reach your goals? So everyone's risk return balance point will be affected by many factors, such as one, your time horizon. That is, how long before you need to use the money from your investments. If you need the money from your investments in 2 years, say for education, you won't want to take on much risk and likely won't want to put money into the stock market. You should only put money into the stock market if you don't need it for 5 to 10 or more years. And someone who doesn't need their money until retirement in 35 years will likely be willing to take a greater risk. 2, your age. So for example, younger people tend to be better able to accept higher risks than older people, since they have a longer time period to recoup losses through the income they earn in their career if the value of an investment falls or if they lose on an investment. Number 3, your wealth and how much you have to invest. So those with more wealth are usually in a better position to accept more risk, since it is easier for them to afford a loss. And finally, at 4, your goals and how much you're hoping to earn from your investments in order to realize your goals. If you set a certain goal and find that you will need an average return of 10% on your investments to reach your goal, are you comfortable with that level of risk? And if not, you might have to change the goal or set a longer date to give yourself more time. So moving forward, we do have a Zoom poll. Now, suppose you decide that you would like to buy and sell stocks as one of your investments. And suppose that you haven't had a lot of experience with investing in the stock market, and therefore you decide to work with a broker. And this broker, you tell your broker that you have some savings and you would like to achieve the following. You want your investments to hopefully make a 20% return each year, and you don't want to run the risk of losing anything more than 5% of the value of your savings. Is this a reasonable thing to ask on your part? So just to reiterate that, is it reasonable to ask for a 20% return with a 5% risk? We have some people saying no, lots of no's. Okay, it looks like most people are saying no. Which is correct. The answer, unfortunately, is no. And that reason is that your potential return on an investment and your potential risk have to be in balance. So if you want your investment to provide a possible 20% return, you have to accept the risk that your investment may fall 20% or more in value. And the higher your target return, the more risk you have to take on. And if possibly losing 20% of your savings is more than you are comfortable with, then you will have to lower the target for your potential return. And by the way, a 20% return in 1 year is pretty difficult to achieve anyways. So in summary, the key takeaways for section 2. The first is that there are 3 main asset classes: cash, fixed income, and equities. Very important to understand the differences, as these are foundational elements to investing, so your money works hard for you. 2, being mutual funds and ETFs are great ways to start investing. Both provide instant diversification by investing in a pool of assets. Mutual funds are much more expensive than ETFs, so make sure you understand the fees and are comfortable that you're getting good value for the money that you're spending. And 3, remembering that there's always a fairly direct connection or correlation between risk and return. And if you're looking to minimize your risk, then you can also expect to see a lower return. And if you are looking to maximize your returns, expect to endure a higher risk. And understanding the time horizon of your investments. Don't be a forced seller of depreciated assets. So we're already moving into section 3, which is investing efficiently. And it's very important to invest efficiently, especially when you're just starting out. You want every dollar that you invest to be used to its maximum potential rather than being wasted on taxes. And in this section, we'll discuss how to invest efficiently to maximize your earnings. So when it comes to investing accounts, there are generally two different types, and we'll review the differences between registered and non-registered investment accounts. And then we'll focus on some specific account types, particularly those that are most important to young people, which are TFSAs and RRSPs, which both offer tax advantages to help you reach your savings goals. And if you can afford it, a really good strategy is to contribute as much as you can to both. And we will take a look as well at how non-registered accounts can eat away at your returns due to taxes paid. And finally, we'll discuss seeking advice and how to develop your judgments to make better money decisions. Now, there are two types of investment accounts. There are registered accounts and non-registered accounts. And you can think of these investment accounts as containers that hold all sorts of investments. And you can keep cash equivalents, fixed income assets, and also equities, even mutual funds and ETFs in your investment account. So a registered account is an investment account that is given tax deferred or tax sheltered status by the government, which means that that income is earned in this account, like capital gains or dividends, are not taxed until withdrawal, or in the case of a TFSA, is never subject to taxation. In order to ensure that registered accounts are used for their intended purposes, the government puts rules in place that must be followed. For example, contribution limits. And in this presentation, we'll be covering 2 of the more applicable registered accounts for young people, which again are RRSPs and TFSAs. But those aren't the only 2 types. So take an RESP, for example, which is a registered education savings plan, which is a registered account meant to help parents save for their children's education. Now, a non-registered account does not enjoy the same tax sheltered status as its registered counterpart. They are a general investment account where you can invest a wide range of assets and are required to pay taxes annually on income generated by the account. And investors appreciate non-registered accounts flexibility as they don't have any contribution or withdrawal limits. A common type of non-registered brokerage account is a cash account. So cash accounts are investment accounts in which income is taxable in the year earned, and if there are capital gains, dividends, or interest income. If you have already maxed out your registered accounts, TFSAs, and possibly RRSP, depending on your income, a non-registered account allows you to continue investing. And a general rule of thumb is that if your annual taxable income is less than $50,000 per year, or around $50,000 per year, a TFSA makes a lot of sense, but it likely doesn't make as much sense to contribute to an RRSP, and a non-registered account might make more sense once you have fully contributed to your TFSA. So non-registered accounts are Canadian investment accounts which can be taxed. As a rule of thumb, you can expect any form of earning in this account to be taxed. So 50% of your capital gains are taxed in a non-registered account. The tax rate depends on your personal tax bracket. So if you are in the highest tax bracket in Ontario, you would thus pay around 27% on capital gains. Now, 100% of the interest you earn in a non-registered account is taxed. So once again, this tax rate will vary based on your personal tax bracket. And if you were in the highest tax bracket in Ontario, you would pay around 54% tax on interest income. When it comes to dividend earnings in a non-registered account, you will be taxed based on your personal tax bracket. And qualified Canadian dividends are eligible for a 15% federal dividend tax credit plus a provincial tax credit. In Ontario, that is an additional 10% tax credit, which will cut your effective tax rate. And if you have less than $50,000 in annual taxable income, you may actually be charged a negative tax rate on dividends due to these tax credits in Ontario. Investors in the highest tax bracket in Ontario pay tax of around 39% on dividends compared to about 54% on interest income and about 27% on capital gains. So as you can see, a non-registered account is completely vulnerable to taxes, and in most cases, it's not a great idea to open a non-registered account, especially when you're just getting started with investing. Investors tend to open a non-registered account only after they have filled their contribution limits of their TFSA and RRSP if they're in a higher tax bracket. So now we can move forward to the next slide, taking a deeper look just at how effective registered accounts can be at saving you money. So a good investment vehicle for many young people are tax-free savings accounts, or TFSAs. And you can use a TFSA for any savings goal, short or long term. And many people like to describe a TFSA like a storage container, and you can store all kinds of stuff in it. So for example, you can put in your cash, your GICs, bonds, stocks, mutual funds, and ETFs all in your TFSA. And the best part is that all of those investments grow tax-free inside of that account. So simply what it means is that you won't have to pay any capital gains taxes nor income taxes on your investments growth, and this can really make a difference over time. And finally, as an added bonus, you also won't pay any tax on withdrawals from your TFSA. So you can move money in and out of the account without any tax consequences, of course, as long as you are following the rules. So if you have, if you're taking money out of a TFSA, you can't replace it until the following year. So there are contribution limits up to a maximum amount each year. So for example, in 2021, the maximum amount is $6,000. Otherwise, everyone would put all of their investments into a TFSA. And there's some good news though. Let's say you can't make a full $6,000 contribution in 2021. You can actually put the difference plus the following year's limit next year. And that's because the contribution limit is cumulative. And so unused contribution room rolls over from one year straight to the next. And you can find out how much contribution room you have in your TFSA by making a CRA My Account. So for Canadian residents who were 18 when the TFSAs started back in 2008, you could put up to $75,500 into an account right now if you haven't made any contributions yet. And moving forward, we can also discuss RRSPs, which is another noticeable investment account for young people. So an RRSP is a registered retirement savings plan, which is meant to help your investments grow, again, tax-free like a TFSA, until you are ready to retire, and offers other tax advantages too. So investments that can be held in an RRSP are called qualified investments, and they include cash, GICs, bonds, both government and corporate bonds, mutual funds, as long as they are RRSP eligible, ETFs, and equities for both Canadian and foreign stocks. And by using an RRSP, you get immediate tax relief by deducting your RRSP contributions from your income each year. So you don't get that tax deduction with the TFSAs. Effectively, with an RRSP, your contributions are made with pre-tax dollars. So the money you make on your RRSP investments is not taxed as long as it stays in the same plan or account. So you'll pay tax on your RRSP savings when you withdraw from the plan, and that includes both your investment earnings and your contributions. But you have deferred this tax liability to the future when it's possible that your marginal tax rate will be lower in retirement than it was during your contribution years. So the intent of an RRSP is to be a plan where you put your money once you start earning enough to enter a higher tax bracket. And by putting it into an RRSP when your taxes are high, you'll be able to decrease the amount you'll have to pay. And the benefit of this becomes pronounced if you then leave the money in this account to compound all the way until your retirement, when your taxable income should be far lower than your prime working days. So the income that you may have paid 33 to 43% marginal tax on earlier in life may only be taxed at 20% depending on your post-retirement income. And that's as much as a 23% tax savings, or if you're in the highest tax bracket, 33% savings on your tax burden. When combined with compound interest, RRSPs can be a really great investment strategy once you're in a higher tax bracket. And your RRSP contribution room accumulates each year too, based on your annual taxable income. And for 2021, the maximum contribution is $27,830, or 18% of your earned income, less your pension adjustment. And moving on to the next slide, we'll see a chart that highlights a few of the important distinctions between investment accounts. So while they are both storage containers, meaning that you can put investments in them, you should note that there are some important distinctions. So first being that a TFSA can be contributed to without any income, whereas you can only place a percentage of earned income into an RRSP. And contributions to a TFSA are not tax deductible, whereas contributions into an RRSP are. And you can withdraw from a TFSA without paying any taxes on the withdrawn amount, unlike an RRSP. And if you don't use your annual contribution room in either a TFSA or an RRSP, it will accumulate. And also it's worth pointing out that you can continue to use a TFSA or for tax-free investment growth your entire life, whereas money in an RRSP must be transferred to a different type of account after age 71. After all, it is meant for your retirement. So it's important to realize that making good money decisions could require help and advice. And note that you should only use trusted and reliable sources to assist you, and understand the qualifications of anyone claiming to be able to assist you financially, and ensure that you are being informed about all related costs, terms, and fees associated with any financial advisor before becoming involved with them. And while it is possible to do your own investing with help from banks and online brokerages, however, although you will have to pay a fee to work with an advisor, it may be worth it, especially, this is especially true if you don't know a lot about investing if you are just beginning. And they may be able to help you get the return you're looking for, even taking into account the fee that you pay for the help and advice, Whether you seek an advisor's assistance or you prefer to do it yourself, it will always be important to set goals, work through your comfort with risk, pick appropriate investments, diversify, and put together a financial plan. And finally, you must be aware that all stocks must be bought and sold through a licensed broker. And a broker is someone who is trained and has a license to buy and sell stocks. This may be a broker who you pay a fee to get help and advice, or it might be an online brokerage company that lets you make your own buying and selling decisions. You will pay, for which you will pay a lower fee if you make your own decisions, although you won't get any advice. So moving forward to developing your judgment, it takes time, and it's really important to understand that this is a learning process rather than something that you can just pick up within a few days. It's important to always verify your knowledge by referring to multiple sources. For instance, if you just want to learn more about ETFs, you should compare multiple sources rather than just taking information from one source. And know that free knowledge is readily available on the internet, but again, using your personal judgment to pick out information all from the right sources. So the key takeaways from Section 3 here are that generally everyone should have a TFSA. There's quite a bit to know about TFSAs, but they're a good investment for young people to have. I have one, look into one, ask about them, and see if they would really work out for you. Second, taxes can eat away at your returns. So it's really important to use investment accounts to your advantage. Recall the tax implications associated with non-registered accounts, as they can really add up over time. Ultimately, it's what you keep that matters. So when you're considering investing, always be aware of the investment account options available to you and take advantage of those tax benefits. And finally, developing your judgment to make better money decisions is a whole process as opposed to something that you can just pick up overnight. So do your research, ask questions, compare answers and advice to what other reliable sources are saying to verify your knowledge. And with anything, be sure to seek help or advice if you need it. Just make sure that you're consulting with credible advisors and do your own research on the fees associated with seeking professional services. So in summary, just to review what we've learned today, first, understanding inflation and how earning more than inflation is important, and remembering that the money you have today will be worth less in the future. So that means in order to start investing, you need to, therefore investing is a really great way to keep up with inflation when you're looking to store your money. And second, if you don't have savings, you can't invest. So once you have savings, you can make decisions about how to invest them. And that means in order to start saving, you need to find small ways to set aside some money every month for the purpose of ultimately investing in you and your future goals. And third, when should you start investing? The answer is right now, today. When it comes to investing, you want time on your side, which will allow for that magic of compounding to really grow your investments. And in summary of Section 2, we have 3 main asset classes, which are cash, fixed income, and equities, all very important to understand the differences, as these are foundational elements to investing basics. And next, we had mutual funds and ETFs, which are both providing instant diversification by investing into a pool of assets, and remembering that mutual funds are much more expensive than ETFs, and just making sure that you understand the fees associated with each type. And third, remembering there's a fairly direct correlation between risk and return. And if you want to minimize your risk, expect to see a lower return, while also if you're looking to maximize your returns, expect to endure a higher risk. And key takeaways from the third section include TFSAs, there we go, are a must-have. They're generally a good investment for young people, so look into them, see how they could work for you. Second, that taxes can eat away at your returns, so be sure that you're getting knowledgeable on the investment accounts and how to use them to your advantage. And third is finally developing your judgment to make better money decisions and knowing that it is a long process and not just something that you can pick off on overnight. And on the slide here, we just have some learning objectives. So coming out of this workshop, we hope that you have developed the foundational skills to allow you to invest with confidence and why it's important to invest for your future to help outpace inflation. And two, the foundational skills what basic investment asset classes exist, which are being cash, fixed income, and equity. And three, knowing the various account options there are to investing. So registered accounts like TFSAs, RRSPs, and non-registered accounts and tax implications. So with all that being said, what are your next steps moving forward? Well, first consider setting up a practice trading account at a discount brokerage or through tmx.com. Go through the motions of investing, which means doing your research and finding investment options that work for you. You should also consider talking to a financial advisor about investing. And one of the simplest ways to do this is through your bank, but you are encouraged to, again, do your research and find some options and finding a financial advisor or financial advisory firm that you feel comfortable working with. And also, again, just pressing the concept of a TFSA, which is something you should really be looking into getting if you already have one, making sure that you are taking full advantage of it. And as we discussed today, a TFSA can have really tremendous benefits, especially for young people and those in lower income tax brackets. And you can open a TFSA with a bank or a credit union or insurance company, but also with a financial advisor. And finally, of course, be sure to check out additional CFEE program resources. So just before we wrap up and take any questions that you might have, I want to offer a few bonus or final tips when it comes to investing. So number one, being don't panic if things don't go well. Keep calm and avoid making any irrational decisions. One key item is to be aware of your time horizon and to only invest money in riskier investments when you don't need access to that money for 10 or more years. When the market fell sharply in 2008, it recovered most of its losses in the year or two following. And after the market drop in early 2020, it was mostly fully recovered within the year. So those who sold their investments, those who panicked, when things got bad, lost out on money. Meanwhile, those who held on and didn't panic in most cases got their money back. So be sure to avoid panic, be careful about making any quick decisions. And if things, start to go a little crazy, remember that there's a big difference between a loss and a loss on paper. And next, to remember to keep inflation in mind when you are making your investment decisions. So you'll want to earn a rate of return that is at least equal to the rate of inflation. Otherwise, you could be losing money. If the inflation rate is 2% and your investment is paying you 1.5, that is actually a loss of 0.5%. And finally, and I cannot emphasize this enough, invest even small amounts and you will be surprised with how they can add up over time. So recall our example of compound interest. $2,000 a year might not seem like much, but after decades of compound growth, you're looking at a very substantial sum that could go a long way to help you reaching your future goals. Which ties this entire presentation together. Why invest? It's about putting money that you don't need today to work for you to help you achieve your goals in the future. And just on the final slide, as a final thought, investing is something that should be considered by everyone, not only to those with lots of money or great deals of wealth. Investing is not only good for the individual investor, but it is also providing fuel for growth and development for our whole economy. So be prepared to be an investor at whatever level is possible for you and at whatever age you are. Investing can work to your advantage, bring benefits, and help you to achieve your goals. Invest when you can and invest what you can, but do so wisely, and make investments that are comfortable for you. So now I believe we can get to answering any questions, if there are any. I do see one question. Should we invest even though it's just a few dollars? I would say yes, as mentioned. If you can only contribute a little bit, it has the potential to build up and accumulate over time. So if you maybe set aside some coffee money that you spend every month, or like me, maybe don't go on that shopping spree every month and just set a little bit aside, and it can definitely accumulate and grow over time.